Are we in a housing bubble? With all the headlines and buzz in the media, some consumers believe the market is in a housing bubble. As the housing market shifts, you may be wondering what'll happen next. It's only natural for concerns to creep in that it could be a repeat of what took place in 2008. The good news is there's concrete data to show why this is nothing like the last time. There's a shortage of homes on the market today, not a surplus. The supply of inventory needed to sustain a normal real estate market is approximately 6 months. Anything more than that is an overabundance and will cause prices to depreciate. Anything less than that is a shortage and will lead to continued price appreciation. For historical context, there were too many homes for sale during the housing crisis, for which many were short sales and foreclosures, and that caused prices to tumble. Today, supply is growing, but there's still a shortage of inventory available. One of the reasons inventory is still low is because of sustained underbuilding. When you couple that with ongoing buyer demand as millennials age into their peak home buying years, it continues to put upward pressure on home prices. That limited supply compared to buyer demand is why experts forecast home prices won't fall this time. Mortgage standards were much more relaxed during the crisis. During the lead up to the housing crisis, it was much easier to get a home loan than it is today. Running up to 2006, banks were creating artificial demand by lowering lending standards and make it easy for just about anyone to qualify for a home loan or refinance a current loan. Back then, lending institutions took on much greater risk in both the person and the mortgage products offered. That led to mass defaults, foreclosures, and falling prices. Today, things are different, and purchasers face much higher standards from mortgage companies. Stricter standards like there are today help prevent the risk of a rash of foreclosures like there was last time. The foreclosure volume is nothing like it was during the crash. The most obvious difference is the number of homeowners that were facing foreclosure after the housing bubble burst. Foreclosure activity has been on the way down since the crash because buyers today are more qualified and less likely to default on their loans. In addition, homeowners today are equity rich, not tapped out. In the run-up to the housing bubble, some homeowners were using their homes as personal ATMs. Many immediately withdrew their equity once it built up. When home values began to fall, some homeowners found themselves in a negative equity situation where the amount that they owed on their mortgage was greater than the value of their home. Some of those households decided to walk away from their homes, and that led to a wave of distressed property listings, foreclosures, and short sales, which sold at considerable discounts that lowered the value of their other homes in the area. Today, prices have risen nicely over the last few years, and that's given homeowners an equity boost. With an average home equity now standing around $200,007, homeowners are in a completely different position this time. If you're worried about where making mistakes that led to the housing crash, rest assured regulations have been established since the last housing crash that should help alleviate your concerns. Concrete data and insights clearly show why this is nothing like the last time. If you have any other additional questions, please reach out. I'd love to have a conversation with you.